There is a profound illusion at the center of modern wealth building, a paradox where the ultimate symbol of financial security is actually a silent, relentless liability. Physical currency and bank deposits offer an intoxicating sense of safety, promising absolute liquidity and immunity from market volatility. Yet beneath this comforting veneer, a mathematical certainty is quietly dismantling your net worth. To hold excessive capital in zero-yield environments is not a defensive posture, but a guaranteed surrender of future purchasing power. This phenomenon is driven by inflation, the macroeconomic force that dictates the general increase in prices and the subsequent fall in the purchasing value of money. When central banks expand the money supply or supply chain bottlenecks, restrict the availability of goods, the fiat currency sitting dormant in a checking account loses its fundamental utility. $100,000 held in a vault for a decade does not remain $100,000 in economic energy. It becomes a fraction of its former self, capable of acquiring significantly fewer assets, goods, or services. The danger lies in the invisible nature of this erosion. Unlike a sudden stock market crash that triggers immediate panic and portfolio rebalancing, the devaluation of dormant capital happens in fractions of a percent, month over month. This stealthy decay makes excessive liquidity one of the most insidious threats to long-term financial stability. You are effectively paying a heavy premium for the psychological comfort of seeing a static number on a screen, ignoring the reality that the intrinsic value of that number is in a state of continuous freefall. Beyond the direct loss of purchasing power, there is a secondary, far more devastating penalty known as opportunity cost. In financial terms, opportunity cost represents the potential benefits an individual, investor, or business misses out on when choosing one alternative over another. By electing to keep capital entirely liquid, you are not merely standing still economically. You are actively forfeiting the compounding growth generated by equities, real estate, or fixed income securities that historically outpace the rate of inflation over extended time horizons. Consider the economic landscape of the past 50 years. If an individual had parked $100,000 in a non-interest-bearing account in 1980, the nominal value would remain entirely unchanged today. However, the actual economic leverage of that capital would be decimated by decades of compounding inflation. Conversely, had that same capital been deployed into a broad index tracking the largest publicly traded companies, it would have participated in the massive wave of corporate innovation, global expansion, and technological advancement, multiplying its original value exponentially despite periods of severe market turbulence. The chasm between these two outcomes serves to demystify the counterintuitive reality of capital allocation. Cash is a depreciating asset masquerading as a store of value. When capital is deployed into the broader market, it ceases to be static paper and transforms into ownership stakes in productive enterprises. These enterprises actively adjust their pricing models and operational strategies to combat inflationary pressures, inherently passing those adjustments along to shareholders in the form of capital appreciation and dividend yields. The historical returns of diversified investment portfolios present a stark contrast to the stagnant nature of uninvested reserves. While equity markets experience inevitable cyclical downturns, the long-term trajectory has consistently rewarded those who exchange the illusion of absolute safety for the calculated assumption of market risk. The difference between a 0.0% return on static capital and a historically average annual market return of 8.5 to 10.2% is not just a marginal gain. Over a 20-year period, it is the difference between financial stagnation and generational wealth creation. This principle is acutely understood at the highest levels of corporate finance. Multinational corporations rarely hoard excessive liquidity without a specific strategic mandate. Chief financial officers view idle capital as an inefficient burden on their balance sheets. Instead of letting billions sit dormant, they aggressively deploy excess reserves into research and development, strategic acquisitions, or share repurchase programs. When a company holds too much unallocated capital, activist investors often intervene, demanding that the funds be put to productive use or returned to shareholders, recognizing that stagnant money destroys shareholder value. The broader macroeconomic environment further dictates the penalty for hoarding reserves. Central bank policies, specifically the manipulation of interest rates, constantly alter the risk-to-reward calculus for investors. During periods of economic expansion, keeping capital on the sidelines means missing out on robust corporate earnings growth. Even during complex economic phases characterized by a yield curve inversion, a scenario where short-term debt instruments carry higher yields than long-term instruments, often signaling an impending recession, strategic investors do not retreat entirely to cash. They pivot to defensive sectors or high-yield fixed income to maintain forward momentum. The overarching mechanics of global finance are designed to penalize stagnation. Capital must flow to generate economic activity, and the system inherently rewards those who facilitate this flow by risking their capital in the marketplace. When you hoard currency, you are stepping outside this engine of growth, isolating your wealth from the very mechanisms designed to expand it. The modern financial ecosystem operates on continuous forward motion, and remaining stationary is mathematically equivalent to moving backward. This is not to suggest that all liquidity is inherently detrimental. A crucial distinction must be made between a highly strategic emergency fund and economically inefficient excess. An emergency fund is a foundational element of sound wealth management, typically comprising 3 to 6 months of living expenses held in highly liquid, easily accessible accounts. This specific allocation acts as a financial shock absorber, protecting your broader investment portfolio from being prematurely liquidated during unexpected life events or sudden income disruptions. The purpose of this foundational reserve is insurance, not wealth accumulation. It provides the psychological fortitude required to weather short-term volatility without making irrational, fear-based decisions regarding your long-term assets. However, once this defensive perimeter is fully funded, any additional capital added to the static pile immediately begins to suffer from the dual forces of inflationary decay and opportunity cost. Recognizing the exact threshold where a prudent safety net morphs into a financial liability is a critical evolutionary step for any serious investor. Crossing this threshold requires a fundamental shift in how one perceives risk. The traditional view equates market participation with danger and liquidity with safety. The sophisticated view recognizes that guaranteed loss of purchasing power is the ultimate danger. To mitigate this, capital must be methodically deployed across a diversified array of asset classes. Equities offer aggressive growth potential, real estate provides tangible value and inflation hedging, and fixed income securities offer predictable, albeit lower, yields to stabilize the overall portfolio. In the modern era, the avenues for capital deployment have expanded dramatically. Investors can now align their portfolios with broader global trends through sustainable investing, a strategy that directs capital toward companies demonstrating strong environmental, social, and governance practices. By actively participating in these forward-looking sectors, investors not only seek financial returns but also position their capital to benefit from the inevitable global transition toward more sustainable economic models. The uninvested alternative, by contrast, captures none of this transformative upside. Furthermore, the velocity of modern markets, driven heavily by algorithmic trading, means that opportunities materialize and vanish with unprecedented speed. Algorithmic trading involves the use of computer programs to execute trades at high speeds and volumes based on predefined mathematical criteria. This phenomenon, often referred to as cash drag, ensures that capital left on the sidelines is entirely blind to these rapid price discoveries and the subsequent wealth generation they facilitate. The psychological barrier to entering these dynamic markets often stems from the fear of timing. Investors worry about deploying their reserves at a market peak, only to suffer an immediate drawdown. This hesitation frequently leads to a perpetual state of waiting for the perfect entry point, a strategy that historically underperforms consistent, methodical investment. The cost of waiting for a market correction is almost always higher than the cost of enduring the correction itself, as the intervening period of growth is permanently lost. An examination of the aftermath of major global financial crises illustrates this point vividly. Following severe market contractions, the recovery phases are often characterized by explosive growth as asset prices normalize and economic activity resumes. Investors who retreated to absolute liquidity during the downturn and failed to redeploy their capital missed out on the most lucrative phases of the subsequent bull markets. The historical record clearly demonstrates that time in the market consistently triumphs over attempts to time the market. Ultimately, managing your wealth requires adopting a mindset akin to fiduciary duty. In the financial industry, a fiduciary duty is the legal and ethical obligation to act in the absolute best interest of another party, prioritizing their financial well-being above all else. When managing your own capital, you must act as your own fiduciary. This means making objective, mathematically sound decisions rather than succumbing to the emotional comfort of excessive liquidity. It requires acknowledging that calculated risk is the mandatory price of admission for long-term preservation. The true measure of wealth is not the nominal amount of currency you possess, but the economic power that currency commands. If your net worth is growing at 2.5% while the cost of living is expanding at 4.2%, your actual wealth is contracting. You are slowly being priced out of the future you are attempting to save for. Recognizing this reality forces a necessary confrontation with the limitations of traditional saving methods and demands a more aggressive approach to capital deployment. We are currently navigating an era of profound economic complexity where fiat currencies are subject to unprecedented pressures from global debt loads that frequently exceed national GDP figures. In such an environment, the reliance on unbacked currency as a primary store of value is a historically anomalous and highly precarious strategy. Hard assets, productive equities, and innovative technologies represent the most viable lifeboats against the steady dilution of the monetary supply. The transition from a saver to an investor requires dismantling the deeply ingrained belief that cash is king. Cash is merely a temporary vessel, a medium of exchange meant to facilitate the acquisition of true assets. When it is hoarded indefinitely, it becomes a wasting asset. The opportunity to build enduring wealth lies in recognizing the precise moment when liquidity ceases to be a shield and becomes an anchor, weighing down your financial trajectory. To optimize your financial architecture, conduct a rigorous audit of your current reserves. Calculate your exact monthly expenditures and establish a definitive ceiling for your emergency fund. Every dollar that exceeds this calculated threshold must be viewed as unemployed capital urgently needing an assignment. Whether that assignment is funding a retirement account, acquiring real estate, or investing in your own entrepreneurial ventures, the mandate is clear. The capital must be put to work. Implementing this framework transforms your relationship with money from passive accumulation to active management. You begin to view market fluctuations not as threats to your security, but as natural cycles within a broader trajectory of growth. This proactive stance neutralizes the silent threat of inflation and positions you to capture the compounding returns that are the hallmark of true financial independence. The goal is to build an economic fortress, and an economic fortress is constructed with productive assets, not stacked paper. The consequences of ignoring these principles are stark and unforgiving. A lifetime of disciplined saving can be systematically dismantled by the invisible tax of inflation and the crushing weight of opportunity cost. The tragedy of excessive liquidity is that it often afflicts the most responsible individuals, those who prioritize financial safety but fail to understand the macroeconomic forces working against them. They arrive at their financial destination, only to find that the currency they so carefully guarded can no longer purchase the life they envisioned. Prosperity in the modern economic landscape demands a sophisticated understanding of capital velocity and the courage to abandon the illusion of static safety. By demystifying the counterintuitive risks of hoarding currency, you unlock the strategic perspective necessary to navigate complex markets. The path to enduring wealth is not found in the passive accumulation of depreciating paper, but in the intelligent, relentless deployment of capital into the engines of global economic growth. The choice is yours to make, and the cost of inaction is too high to ignore.